We've got buyers at higher prices, buyers at lower prices. Algo's still pressing here, so the algo we're interested in is these greens on the lower prices. You can see that we finally take out one of the algorithms here. Okay, so we finally take out one of the algorithms on this drop. We find some buyers still willing to come in at lower prices. And we see an empty bar top edge. See how all that selling pins at the top edge, and you go, wait a second, that's an empty bar. There's no more buyers at higher prices, right? That's finished. We knew it probably would be finished because of that break lower here. So when it shows up as finished up here, that's your starting point for a possible sell play, right? So you start looking at that after we start seeing that pin rejection for possible sells up here. That's the safe sell trade. The fact that buyers still come in here is obviously a little bit unusual. The fact that they haven't yet switched off, another failed auction here gets them on the run, and they buy one last time, probably because it's still in a bracket high. Buy one last time here, and again they have another failed auction. Well, they didn't hang around because they sold here and they sold here for the selling phase to start early. They suddenly realize we're in the wrong trade here, and they go from buy side trades on that side to sell side trades on this side. You can see the selling drives the price beautifully to the downside all the way through that whole process. Great little bit of business there. When we see that the buyer gets jammed at the top edge here and then sells off, and the seller's still dominating here, seller's still dominating here, seller's still dominating here. So selling down into these sellers at lower prices, it's been pretty much a dominant sell side display all the way through that whole process. One of the questions that a lot of people sometimes get mistaken about is this idea about bonds and equities, this idea about the bond, the Nasdaq against the S&P's relationship to duration, for example. So it's one of those things that you've got to try and get your head around, the idea of the S&P against equity, the S&P against the Nasdaq, the idea of durational trades, the Dow Jones against the Nasdaq, the idea of those types of sentiment trades. So when we understand that, the Nasdaq should outperform the S&P when interest rates are doing what? When interest rates are falling, bond prices are rising, the Nasdaq should outperform. So when we look at the Nasdaq as a relationship to the S&P, we can start to see the areas where the Nasdaq starts to underperform. So we can see, for example, here, the Nasdaq is underperforming. That's suggesting that equities are getting put under pressure because of some sort of higher rate narrative. And that's something that we start to recognize from this little bit of divergence up here. Well, that seems to tie in with exactly the same point where the buy algorithms get murdered. And you can see that when we come into this commercial seller that came in on this divergence here allows you to start recognizing, for example, that there was some sort of interest in this trade, that interest rates still suggesting sell side equities. And obviously the sell away from those trades, we get a very, very nice little bit of a break to the downside, and what a nice popper we get from that trade. So when we put that into perspective, we can see just how strong some of these narratives become. We can see into the bottom pullback, for example, here we can see that there's a little bit of a value divergence creeping into the Nasdaq to buy off this lower print here just now. The interest rate narrative is becoming bullish for equities, and that's why we're starting to see equities on a rally just here. It's the first time it's happened, hasn't it? It's the first time we've actually physically seen that bullish interest rate narrative. Bullish. When I say bullish interest rate narrative, I'm talking about bullish for equities interest rate narrative, because this is what this line tells us. This line tells us that this is bullish interest rates for equities, and equities have been able to catch a nice little bid off of that bullishness running off the bottom print there. That's okay. Nice little trade, nice little outcome. So we can see the bearishness for equities here at that higher price, the buyers getting jammed into the higher prices, the commercial seller coming in, the algorithmic seller just below, and the push to the downside out of that area. So when we start to see these stories evolving, we can't not see them. They were evolving very strongly off these high prints up here, very strongly. There is a negative interest rate environment coming into equities right here. Has to be. That's why the black line's dropping. And then when we start to pick up on that at these higher prices, it's a great idea to look for that short NASDAQ trade right off those prints. The sell away from that is a lovely little bit of business. As I said, into the low prices here and into this retested low here, you can see that this buy trade from the NASDAQ is also incredibly very, 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 very positive in this sense here. Very positive. So we're having some good upside gains here on the Qs at the moment. Very, very nice. Thank you very much. And if anybody decided to buy the 15.7, we're getting around about 15.124. So we're making around about 50 points. That's a $1,000 gain. $1,000 gain. And a reasonable trade outcome. A reasonable trade outcome, guys. Now, we've got to try and understand this because it's a funny little fella, isn't it? We can see into the bottom edges here, for example. We can see how much value is in this buy trade in here. You can see these big block buy trades at the bottom edges giving us some real strong insight into buy opportunities during that type of phase there. And we get this very large lift in the London session away from those prints, going from 19,160s to 19,250s. We're making 90 points. That's nearly $2,000 of upside profits on the NASDAQ during that period. And you can see that the interest rate sensitivity in stocks was very, very bullish, and we should be able to make a lot of money on stocks. Now, the interesting thing about this narrative, of course, is that the best trade isn't actually even on the NASDAQ, is it? We can obviously already understand that the best trade would actually be in what? The S&P, right? The S&P, it's got to be, the best trade must be in the S&P because the interest rate environment is suggesting that we should be positive for equities. Positive for equities. And obviously inside that positive for equities, the market that's discounted must be the S&P at that stage, right? So when we look at the S&P, we can already recognize the S&P was away down here. What the hell is even that, right? So we go long S&P, we start buying up all that S&P at the bottom edge down here, and whoosh, enormous profits on the S&P. Enormous profits on the S&P. NASDAQ S&P, Laurie Allen. Laurie Allen? I've just combined both of you to make one person. So it's the NASDAQ S&P. And it's just looking at that, what we would basically term the durational line, right? It's a durational line. It's looking at stocks that do well with short duration and stocks that do well or better with long duration. So if it's going up, it means that duration is positive for equities. Discounted product is probably the discounted product has to be the S&P during those periods. The discounted product must be the S&P during those periods, and we add that into the mix. We don't just take it as a standalone. We have to add that into the mix with things like the ABCs, for example, because they're probably also having a few problems because the ABCs are positive equities, but they're also positive yields. But if the yield is having a negative impact on equities, we have that problem of trying to make that judgment call. But when it works out, when it starts to line up, like it did in this one here, this becomes a very, very powerful little piece of information. Now remember, the best trade isn't in the Qs. The best trade is in the S&P in those areas, so long as it ties in with other elements of that trade. So you can see it has to be treated carefully. So when you see a trade, for example, setting up like this one here, you can see that block trade there. It should have been a very easy job of getting short from that block trade up here. In fact, I traded that last night. I was actually in that trade last night. I was talking to the boys about it when we were looking at the trade itself. I was selling that trade there. That was actually our trade. And it did pretty good. Did pretty good. So when you see this trade setting up here, and you say to yourself, right, the equities, the interest rate function is negative for equities here, the trade isn't best served on the NASDAQ. The trade's best served on the S&P there. It's got to be. So the better trade would actually be to go into the S&P top edges and sell it. And the S&P top edge was still up here when the NASDAQ even started to sell off. The NASDAQ was leading the S&P in this sense. And the S&P became a really nice short trade a minute later. And then the S&P fell off behind the NASDAQ. So the NASDAQ in this sense gives us a little bit of an edge into some trades on the S&P if the S&P ties in with everything else, like the internals, for example. So when I see this narrative starting to unfold here, when I see that bottom edge there, the best trade isn't buying that NASDAQ, it's buying the S&P at that stage. So if I go into the S&P at that stage, I know I'm going to get a far better price. So there's the S&P buy trade right way, way, way down there. And that's a nice opportunity to buy some S&P at very, very deep, heavy discounts at that stage. Now, a lot of people say, but why would you trade that type of narrative? Why would the S&P ever be lagging the NASDAQ? Because obviously interest rates are dual in terms of their outcomes, aren't they? It's one of the more complicated storylines that people try and get their heads around is the relationship of interest rates and equities. Because obviously if we think about this idea, equities go higher, interest rates don't move. But because equities are going higher, what's happening? Of course, that's probably because companies are making a lot of money. There's a lot of money going around. Equities go higher, brings in the idea of inflation. And obviously, ultimately, interest rates start moving. As interest rates start moving, equities and bonds are going in opposite directions. But obviously, if the interest rates accelerate, they become a hindrance to further gains on equities. And they'll just become a hindrance. They start squeezing margins, but they don't just start squeezing margins. With interest rates a lot higher, of course, equities aren't perhaps as appealing. We're buying an equity that's very highly priced, and yet we could also get a very low risk asset that also pays a high yield. A very low risk asset that pays a higher yield is always going to be a very, very appealing product. So a lot of people will start selling their equities and buying this very, very high yield at that stage, locking in what looks like a brilliant trade. So they buy this very high yield and they sell equities, and equities start trading in the opposite direction to yields. And that's when we see bonds and equities going in the same direction. So this is a challenging narrative, and it's challenging for that reason. Equities are positively correlated to yield, and then are negatively correlated to yield. So we've got to be very, very careful how we use these functions. But it is what it is. You can like it or lump it, but at least if you understand what the narrative is, you can recognize that the narrative is starting to shape up. So when I see that narrative shaping up in here, and I see that there is a positive interest rate environment developing for equities here, my challenge, of course, is to say, right, let's get that bit of business done. So when I look at that and I ask the question, well, that's probably going to be lower interest rates. The ABCs will probably be lower at that stage, and the ABCs are lower at that stage. See the challenge, Laurie? The ABCs are lower. Well, of course they're lower, because for this black line to be going higher, it suggests we're going to be getting lower interest rates. So if we are going to be bullish equities, if we're going to be bullish equities, we're probably also going to be looking at the ABCs as a buy opportunity into those low prints. And obviously the buy into those low prints starts to bring the ABCs back into play off the bottom edges as well. So it's a very, very interesting narrative. It's not quite as straightforward as a lot of people think, but obviously if it's supported by some, for example, some market internals, we can obviously start recognizing the market internal that's associated with this narrative. We can start to see what we're looking for. So if I'm looking for some market internals, we could look at the price of volatility, for example, to see if that was starting to work for us. It wasn't quite. We could look at the market internals. We could look at where's my banker bet? Have I got banker bet on this? We could look at market sentiment. We could see the sentiment hadn't started to improve either at that stage. So you can see it is a very early to trade narrative, right? It's a very early to trade narrative. And you might be completely wrong on that narrative. That's why we don't spend a lot of time covering it, because it is one of those ones that you really have to understand before you start using it, because it's a double-edged sword at times. It's one of those ones that you're getting in so early that nothing else will have turned yet. If that's what's going to happen, nothing else will have turned. And therefore it presents a great early opportunity, but it presents a slightly higher risk opportunity in those areas. And that's what we're very, very cautious of. If that risk is getting bigger, we're getting in early, but we're taking a chance when we do that. So it needs to put a bit of order flow behind it. Great momentum trades because you're in early. You don't mind paying a few extra couple of ticks because you are in so early in that trade. But when it plays out, you make a lot of money very early in a move. And as I said, I traded that trade yesterday for a very, very big profit off of top edges. Make sense though? It's a line that you use, that you can actually use more with the S&P itself. As I said, because the value actually is on the S&P, but as I said, it's a careful, squeaky trade, that one. It's really, you've really got to make sure you do add your, you've got to make sure you do add in your order flow to that, because you are in so early into that narrative.